everyone, and welcome to the ORAH Fund's first professional investor panel series. It's so great to see so many of you logged into today's session, and we are really excited to be able to present such a great event today. My name is Carol Pillemer. I am co-founder of the ORAH Fund together with my husband Russell Pillemer, who will be the moderator of today's panel. The ORAH Fund launched December 2016 as a compelling investment fund of funds where 100% of all management fees are donated to charities which benefit the Jewish community. These donations come entirely from the exceptional fund managers you will hear from as part of this series and do not dilute investors' returns. Our aim is to create a sustainable asset for our community with a long-term revenue stream. It has been amazing to be able to provide support to so many incredible and worthy charities that are really making a real difference to our community and to the lives of those who find themselves in need. Through the foresight of ORAH Fund investors in New South Wales and Victoria and the generosity of our fund managers, the ORAH Fund should reach close to $1 million in donation by the end of the year and counting. After attending our panel sessions, I'm sure you will agree on the impressiveness of the ORAH managers and invite you to please visit the website orahfund.com.au and consider investing in a fund to do well and do good. With that, over to you, Russ, and our awesome fund managers.
Good afternoon, everyone. Welcome to the inaugural ORAH webinar. It's great to see so many attending today. Before we dive into the presentation, I would like to take a few minutes to refresh your knowledge of the fund. The basic proposition of the ORAH Fund is to provide investors with a compelling investment proposition, with a side benefit being that 100% of all fees are donated to Jewish-related charities. I stress that ORAH is unlike all charitable ventures in that we operate a zero-cost infrastructure where 100% of all of our expenses are provided pro bono, including investment management, administration, legals, accounting, and marketing. ORAH seeks to generate for our investors strong long-term risk-adjusted returns. That is, good solid returns with a moderate amount of risk. ORAH's long-term return targets are based upon the magical power of compounding, which shows that if you can deliver good, steady, long-term returns without any significant losses, then over time, you will generate fantastic returns. The way that ORAH targets to generate our strong risk-adjusted returns is twofold. Firstly, by selecting underlying fund managers who are exceptionally good at picking stocks and building portfolios. And secondly, by combining our exposures to these managers in various weightings so as to maximize our chances of achieving our targeted returns. I'm extremely happy to be able to say that we have been fortunate enough to be supported by 12 exceptional fund managers. This includes some new additions that joined only this year, but have already made substantial contributions to the fund. The topic for today is the future of investing. This is a topic which is very close to our heart at ORAH, as we always pitch the fund as an ideal long-term investment proposition. And if you want to generate strong returns over the long term, then it is imperative that you invest with fund managers who are particularly well-equipped and prepared for the future. We have with us today 5 of the ORAH managers who invest in offshore equities, each of whom are amongst the best in the market. What's particularly interesting and valuable for us is that each of these managers has a very distinct area of expertise. And although they are all excellent managers, they all do things very differently. The format of today's presentation is that I will ask a series of questions to each of the participants. Hopefully they will have learned the lessons of the US presidential debates, and so will keep their answers to less than 2.5 minutes and not interrupt each other. Our first panelist today is Mark Arnold, Lead Portfolio Manager, CIO, and Managing Director of Hyperion Asset Management. Mark is the most senior portfolio manager in the Hyperion investment team and chair of the investment committee. Hyperion is a concentrated, benchmark-unaware fund manager that only invests in the highest quality businesses. Hyperion defines quality stocks as those with a high return on equity, low or no debt, and businesses that can deliver highly predictable earning streams through extremely strong competitive advantages. The outcome is a portfolio of modern businesses that are growing in both up and down markets. Mark, Hyperion has been very successful in identifying disruptive companies since your inception. What are the themes Hyperion are investing in at the moment with regards to the future of investing? And how does a stock, for instance, like Tesla, relate to this? Over to you, Mark. Mark, you might be on mute, I think.
The main themes that we're trying to take advantage of really relate to modernisation of the world.
Mark, I think your camera is not on. There we go. All yours, Mark.
Right. The trend to e-commerce, the trend to digital wallets, electronic payments. We think software is becoming more central to society and business. So that's a thematic that we have. Digital transformation of the workforce is another thematic. Advertising is obviously becoming digital, and we still think that's got a long way to go. And the trend to renewable energy and energy generation and storage is another thematic, as is the move to EVs and autonomous vehicles. All of these trends are driven by innovation. Innovation drives disruption, which in turn enables market share shifts. So we think it's really important to invest in businesses that can organically grow market share. And it's particularly important in a low growth, disrupted world, because it's really the only avenue of growth for a business. Tesla's a really good example of a highly innovative and disruptive business. And we think it's going to radically modernise some of the world's biggest industries. It's just started to disrupt the energy industry, which is approximately $11 trillion industry, the automotive industry, which is around $3 trillion. And then ultimately, we think ride-sharing industry will be disrupted as well by Tesla. They've been able to produce really good products. The original Model S has been rated the best car ever produced, not just the best EV, the best car. They're very innovative in terms of their battery technology, their electric engine technology, and they have leading software engineers. So we think their product set is really disruptive, and we think that they've started with cars in terms of disruption, and it's still early days. They're moving into energy markets now, and we think that their main competitive advantage really comes back to that innovative culture. They attract the best engineering talent in the world. And if you look at the graduate surveys, it's normally Tesla or SpaceX that are at the top of the graduate surveys in terms of attractive places to work. So it's a highly innovative business, and we think that lies at the heart of Tesla's competitive advantages.
Thanks, Mark. That's great, especially for those of us on the call who drive Teslas. Our next panelist is John Moog. John is based in Chicago, and he's a partner at Lizard Investors, a specialist manager who invests in small companies around the world. John is also the portfolio manager for the Pengana Global Small Companies Fund. The Pengana Global Small Companies Fund is an actively managed portfolio of global small and mid-cap stocks. These stocks are stocks that are not typically owned by large institutions. The portfolio is well diversified across different geographies and industries, and it uses a value-orientated approach to identify and invest in quality businesses that create significant value but are mispriced, overlooked, or out of favor. John, what is your view on how global small caps will perform over the next 3 to 5 years? Are they well placed in the world of future investing, or should investors ignore them and only focus on the mega stocks where all the action appears to be at the moment?
Yeah, I think that's a really good question. And I think we've been through a pretty interesting period of large caps performing really well relative to small caps over the last 2 to 3 years. But I think when you look on a 20-year history, you can see that small caps tend to outperform large caps by about 3% a year. So we think, that performance in the small cap space right now is been a little bit weak, but we think it's well poised to perform quite well over a 3 to 5 year basis. And I think some of the things really driving that, in our view, that I think become important is I think what Mark alluded to, technology, software, a lot of things that really enabled what we call the unicorns, to pop up, Facebook, Tesla, some of these really amazing businesses that have popped up around the world. You're starting to see that technology start to really get dispersed, but from outside the US, around the world, and into smaller and smaller companies. And you're seeing it really enable some of these small companies to create differentiated competitive advantages and really drive growth in their business. So a lot of that innovation that Mark was talking about is starting to happen in the small cap space. And we think that will create a really compelling environment for which to invest in. So from our perspective, it's a great space to invest in because there's a lot of companies that are sort of under the radar that have really good businesses, really innovative businesses, something that really makes them special and unique. And what we love to do is go out and search and find those and allow them to create a ton of value for us over time. And similarly, Mark thinks about disruption. We like to see it, and we think it's happening quite a bit in the small cap space. And we think that's going to be a big driver of performance over the next 3 to 5 years, and something we hope to capture in our fund, and something that I think will be important for a lot of investors to have access to over time.
Thanks, John. Our next panelist is Damien Green. Damien is head of Australia and Asia for Independent Franchise Partners. Independent Franchise Partners is a privately owned London-based global equity manager. It creates portfolios that adopt an approach that is based upon an understanding that a concentrated portfolio of exceptionally high quality companies selected with an absolute value bias and whose primary competitive advantage is supported by a dominant intangible asset will earn attractive long-term returns with less than average volatility over time. Since 2004, Franchise Partners have offered an Australian vehicle through their local partners, Macquarie Bank. Damien, your firm invests in this concept of franchises. What exactly is this? Why is it so important? And is this relevant for the future of investing?
Thanks, Russell. Look, thanks, Russell. Look, a franchise is probably not that much different to the concept that we all think of, as lay people as a franchise. When we think of a franchise, we think of, a Jim's Mowing or a KFC or a McDonald's. And when you buy a franchise from any of those companies, what you're doing is you're getting a protected asset. So you're getting a particular geography or a particular economic area in which you won't have competition from other franchisees. So you're in possession of an asset that protects you from competitive forces. A franchise is pretty much the same thing, but it's on a global scale and it's owned by a company. It's an asset that protects you from competitive forces. And when you have a company that owns one of these assets, then you don't suffer the incursion of competition that you might suffer in another industry, which enables you to maintain pricing power, maintain your margins, but also immunize you against those sorts of exogenous shocks that come from time to time. So the sort of assets that we look for, that we call those dominant intangible assets, as Russell pointed out, are things like patents and copyrights and licenses and regulatory monopolies, data sets, and those sorts of things. And when you think about for example, one sort of dominant intangible asset being a consumer brand, if you are Nestle, for example, and you have the Kit Kat brand, then you sit on a consumer shelf without competition. Nobody can replicate your packaging. Nobody can get your shelf space. And regardless of any sort of discounting, they can't displace you from the consumer's mind, from being the premium choice and the go-to choice for a chocolate-covered wafer biscuit. And similar with switching costs from, say, Microsoft or Apple or Oracle or such things. So if you can invest in these companies, then what you achieve is you achieve greater certainty through a capital cycle and through a market cycle, And so you're much more likely to, when there's a downturn in the market, you're much less likely to lose your capital. And then over the course of a cycle, you're much more likely to compound at a rate greater than the market. So that compounding effect plus the effect of no surprises, in particular that capital protection in the falling market, tends to make for a very attractive sort of return that our clients have been very happy with over the last 24 years.
Damien. Our next panelist is Stephen Glass. Steve is the Deputy Portfolio Manager of the Pengana International Equity Fund and the Pengana International Ethical Fund. The Pengana Fund invests in a portfolio of global companies diversified across geographies, industries, and company sizes. It operates a benchmark independent mandate, including companies that demonstrate large and growing free cash flow abilities and are priced attractively relative to their cash flows. The portfolio is created from the 30 to 50 stock ideas that work best together, rather than just the 30 to 50 best ideas. This approach has performed particularly well in all market environments. Steve, your fund is known somewhat for investing in stocks that most other fund managers don't invest in. How do you, sitting in Australia, get an edge in global investing, given you often invest in larger companies that are generally deeply researched by the marketplace?
Yeah, look, it's a question we get asked a lot, and a lot of people say, how do you invest globally from Australia? And look, the first point I would make is the proof is in the pudding. Australia's got a very large global investments industry and a very successful global investment industry, so we certainly can do it. But then one of the pushbacks I often get is, how do you actually, where's your edge? I mean, you're in Australia, that company's in Japan, China, India, America, Mexico, wherever it may be, you're so distant from it. How do you get an edge? And my fundamental issue with that, the premise with that question is, it's really implying that if you're not close to something, you can't get an investment edge, which really is saying that you need an information edge. So a lot of people just focus on in investing is, well, you're in a potential information disadvantage being in Australia relative to that country. And the reason that is wrong is that if investing was just about accumulating as much data as possible, you really wouldn't need very experienced people to really do it. You could just plug it into a machine, just add more data all the time. It's actually a lot of the time about the interpretation of the data. And it doesn't matter if you're living in China or you're living in Japan or if you're in Australia, if you don't get the big things right, if you don't interpret the data correctly, you're not going to make good returns. So I think our team's particular edge, and maybe it speaks to why we're in different companies, as you say, different companies, we're not different for the sake of it, is really our ability to interpret information differently. I don't know why it is. Maybe we're just a bunch of weird misfits. I'm not sure, but we look at a set of data. We don't listen to a story. We objectively look at the data and we say, what is that data telling us? And we try to ignore all the other noise around it. And in that way, it's a big advantage being away from those regions you're referring to, because you're not as impacted by the noise. So by having an independent view of companies, we can do a lot better. And at the moment, some companies we've got, and if it comes to questions I can speak to, but I am aware of time right now. An example is Nexon, which is a gaming company in Japan, whose share price dropped in the last result, but we think it was an exceptional result and we've started buying more. And I can give more examples in the Q&A if it comes, but I can just say in general, we focus on the data, and often that means we interpret it differently to people, which means it's not a disadvantage being away from the crowd. In fact, it's an advantage. Thank you.
That's great. Thank you, Steve. Our final panelist is Gabby Dishi. Gabby is a founding partner at Alpha LTI, a boutique Israeli-based fund manager and manager of the Pengana Alpha Israel Fund. The fund's investment strategy is based on comprehensive research of Israeli companies listed on the Tel Aviv Stock Exchange, the NASDAQ, and other exchanges worldwide, with a particular focus on high-growth industries that have a competitive technological product or market advantage, companies that are under the radar with low analyst coverage, companies that have best-in-class management, companies that place a fundamental emphasis on free cash flow, which enable consistent dividend payouts, and finally, private IPOs with lucrative growth potential. Unfortunately, it's the middle of the night in Israel, so we don't have Gabby in real time. But fortunately, we were able to record him and his thoughts on our topic before we move on to our next round of questions. So over to you, Gabby.
Shalom and good afternoon for everyone. Thank you for attending today's webinar, and thank you to the ORAH project for including us in your wonderful initiative. We're very proud to be able to be a part of contributing to the great cause that you support. I was very excited by the topic of today's webinar because investing in Israeli companies is all about the future, including the future of technology, the future of biotechnology, the future of clean technology, the future of agriculture, and ultimately, the future of the world. As you all know, Israel is still a very young country, and although we have come a long way over the last 7 decades, we still face significant challenges, including being a small country with a small population and very little natural resources. However, in my view, luckily for us, none of these factors are particularly significant factors to being successful in the future. The reasons that for companies to be successful over the coming years, they will only need to one key resource, and that resource is human capital. People who have a great education, high intellect, and unbending will to succeed without the fear of failure. In Israel, we have no shortage of this resource. Over the last few decades, we have witnessed some incredible success stories in the Israeli high-tech and low-tech industry as well, with many of these changing the world and generating huge returns for investors. So successful has this been that today, Israel, a country with only 9 million people, has the 3rd largest number of companies listed in the NASDAQ after the US and China, of course. But in my view, as the saying goes, you ain't seen nothing yet. This is just the start, and over the next few decades, the opportunity from investing in Israeli companies will be much more significant of what we have seen in the last 2 decades. This includes companies in high-tech and specialized sectors such as semiconductors, cybersecurity, clean tech, aerospace, automotive, fintech, and many more. In order to illustrate my point, let's take a short glimpse and look at some of the companies of our portfolio that we think will change the world. The first example is Gensel, a company with a technology that aims to replace diesel generators with hydrogen. Another example is Electrion, which is a solution that has the potential to advance the electric vehicle revolution, and in doing so, they reshape the entire transportation industry. Third example is Fiverr, which is a NASDAQ company that operates the world's largest freelance service marketplace. Fiverr has completely disrupted this sector, and in our review, will continue to lead for many years to come. The fourth example is AudioCodes, a duly listed company, a global leading provider of advanced communication software for the digital workplace. They enable enterprises and service providers to build and operate IP voice networks such as Microsoft Teams. Fifth example is Itamar Medical, a medical device company which is focused to widespread the adoption of home digital platform. It addresses the challenge of remote population health management, which will be more common reality in the coming years. The last example is Human Extensions, a company which develops, manufactures, and sells a disruptive digital robotic hand-top innovation for the use of surgeons in surgeries. This device aimed to disrupt surgery, creating a new area of surgical devices, allowing the power of innovation to extend the human touch. Actually, I could go on and on talking about more examples, but hopefully I've made my case and that Israel is a global known for its cutting-edge technology. We are ranked #1 in innovation and R&D expenditure as a percentage of our GDP. We are a high-tech export-oriented economy with a number of leading sectors that I just described. Israel is very well positioned to capture the growth opportunities that will come our way in the world post-COVID-19 and is needed all about the future of investing. Finally, I would also like to mention to you that Australian investors are uniquely placed to benefit from investing in Israeli companies. The reason for this is that the ASX has a tiny proportion of companies that operate in the industries of the future in which Israel excels. Thank you for listening to me, and I hope you found my presentation interesting, and I wish you every success in investing in the future. Shalom and להתראות from the land of milk, honey, and innovation. Thank you all.
Thanks, Gabby. That was great. I think all of us are extremely proud when we hear the stories of innovation coming out of Israel and we see the amazing contribution that Israeli companies have made to the world. Let's move on to talk about some major trends happening in the world over the coming years. I'll start with you, Damien. Your strategies has been operating successfully for 24 years now. That's a long time in funds management. What lessons have you learned along the way that are applicable to the future of investing?
Well, I think, like a lot of fund managers, what we've learned is you can't rest on your laurels. What worked 24 years ago isn't necessarily what's going to work today. So the portfolio from inception in 1996 through to about 2002 was a consumer staples and old media portfolio. Through 2000, 2001, 2002, it performed exceptionally well. It rose, the portfolio rose during a period when the market fell. But what we realized at that point in time is, the market's probably going to learn and we can't rely on that trick forever. So over the next 18 years, we spent a lot of time developing tools and screens and doing a lot of research to find new sorts of franchises, things like pharmaceuticals that own patents and medical instruments, over-the-counter medicines, and also own branded consumers within their own portfolios, data owners like Oracle and Verisk Analytics, and network effects and ecosystems like Microsoft and Apple, and they've come into the portfolio over time. And it actually proved to be very sage because those old media companies eventually declined as new media came in, and those old media companies didn't perform well and they were replaced and their margins did disappear and we'd sold them by then. But there was a secondary effect. And the secondary effect was actually on consumer staples, and certain categories of consumer staples were disrupted because they couldn't use the very expensive old media avenues to maintain their dominance within their markets. And so companies like Kellogg and General Mills in cereals were actually displaced and their margins contract. So being able to buy or find and then buy in these new franchises into the portfolio meant that the performance could be sustained over a period of time. We didn't become old news. And always value. And look, I know over the last 5 years, it's all been about growth, and, we've ended up selling a lot of companies, before they've finished their run, but value is hugely important. Over 24 years, we've learned that, and we've been through market cycles where value has been very important for protecting capital. And that, the end of the TMT bubble was your classic example of that. And then when you look at the performance of the FANGs these days, well, we've owned 4 of them, but we currently own 3 of them. But you know, Facebook, Amazon, and Netflix, they're extraordinarily expensive. And if there is a reversion back to value, those things will struggle. Google's sort of still in the portfolio, and we've been trimming Microsoft and Apple on the basis of valuation. So I think, you know, what we've learned is you've got to keep working, you've got to keep finding the franchises, you've got to keep an eye on that original principle of protecting your client's capital, which back in 1996 was exactly what this portfolio and this strategy was developed for. And you've got to keep focusing on delivering that same set of principles and same set of characteristics to your portfolio, so that your clients can invest with confidence.
That's great, thanks. Steve, over the last years, we boom and now a tech boom again. Where do you think future booms could be?
Yeah, okay, look, if we're going to focus, to focus on the booms, you want to focus on the big things. And so the big things that we rarely see happening are 1, green energy, 2, the Chinese consumer, and 3, just a smaller theme, but still relatively sizable, computer games. So if we start with the Chinese consumer, I'll just say this about China: it's big and it's growing rapidly, and it's got a lot of room to continue growing. So last I looked, consumer expenditure per capita there was something like $2,200 US, which is it's below places like Peru. So you know, there's a long way for that to go. And I won't go into politics, but when the Chinese government says they're going to do something, it happens. And in their last 5-year plan, which was released probably 1 or 2 weeks ago, they said they want to encourage domestic consumption and also technological independence. Now, I'll just go back 10 years ago when that 5-year plan, they said we want to increase infrastructure spend and GDP growth by infrastructure spend. It happened, and we had the resource boom. Then the last 5-year plan was really about reducing industrial capacity. They did that, and now they're saying we want to increase domestic consumption. So it's going to happen. And so we've got investments in life insurers in that market. So we can see consumers spending money on life insurance because you've got 1 child looking after 2 parents without superannuation or life insurance. Guess what? They're going to start doing that. So we've got investment in AIA, which we think is the highest quality life insurance in China. We also own some gaming business, ORAH, which is a site you use to watch games, and we own Tencent and Alibaba, among some other companies. Just moving on to green energy, I think some of my colleagues have already cited it. Again, it's big, it's happening, we believe in it, it's going to do good for the world, and it's actually the right way to go. So we currently have an investment in the world's largest wind turbine business. It's called Vestas. It's based in Denmark. We've doubled our money over the year already from that one, so it's starting to look fully valued to us, but it wins from wind energy. And we've also got an investment in a PV inverter company. So it's a company that makes inverters, which are a special piece of hardware you need in your solar panels. It's the world's 3rd largest. It's called SMA Solar. It's based in Germany. It's very cheap, and we think it's got a reasonable outlook. So those are 2 examples in green energy. And finally, computer games. I won't spend too much time discussing it. Damien just touched on the fact that old media is dying a slow and painful death, which is sad for someone like me who loves investing in media. But the companies that are often taking up that slack are actually these computer games companies. They're booming. So we've got investments in a company called Nexon in China, Tencent in Nexon in Japan, Tencent in China, EA in the US, and we're very excited about these, and we think they're fabulous businesses. So green energy, Chinese consumer, and computer games look like they are strong candidates for future growth and perhaps booms.
Thanks, Steve. That's great. Maybe if everybody in the call can remember, next time you shout at your children to stop playing computer games, they're actually benefiting the portfolio. So maybe change your approach. John Moog, John, in your view, and sitting there in Chicago, what parts of the world do you think offer the best opportunities for investing in the future?
You know, it's interesting, but I think back to Damien's comments about having kind of come through a big period of growth outperformance. You've seen a big period of outperformance here in the US with US equities. And I think we're starting to think ex-US is looking really compelling, especially in the small cap space specifically, which we look at. And we're very much focused on investing in specific companies. But that's really where we're finding the most opportunity. And I think some of the things that are really starting to drive our thoughts on that are starting to see some of this technology that Steve talked about or Mark talked about start to get dispersed down to smaller companies and companies all over the world. And Steve brought up China is a really interesting place where a consumer is growing. And frankly, I think you have some of the best technology in the world coming out of China. And so for us, we are invested in a company called Canada Goose, which makes high-end, let's say, affordable luxury jackets that probably cost about, let's call it $1,000 Aussie for a jacket. This is a great, what we call it, a fallen growth angel. So a business that was growing really fast, fantastic management, hit a few stumbling blocks here in the US as they changed their distribution model, and we think changed it for the better as they started to really move distribution online. But what we love about what we do in the small cap space is, this is a $2 billion market cap, roughly a little larger than that, but they are really poised to dramatically grow in China. And I think, one of the things that in our seat and Steve talked about is we really have a view of the whole world. So there are not a lot of US investors who really understand kind of how this company has positioned itself in China for growth. And we think that's really misunderstood by the market. So, for us, a lot of these situations where we're seeing businesses and technology start to drive really rapid growth in small companies around the world is starting to happen. And I think that's fueled a lot of the move in the US over the last 10 years. And we're really starting to see it outside the US. Another company we're invested in China is a company called Yaka, which is a payments business. And they are the dominant sort of, if you have I don't know if the technology has made its way to Australia yet, by paying with QR codes for Starbucks or whatever it might be. Yaka is the leader in QR codes in China, and obviously the payment space is growing really rapidly in China right now. And we think they've got some of the best technology in the world in this space, not just in China. And we think they have massive market opportunity. And I think, so for us, it's really looking at some of these interesting companies that are starting to innovate and that are really misunderstood or underappreciated by the market that exist all over the world. And we're really optimistic about some of the businesses in Europe and Asia, and think they're going to have are poised for much better than expected growth and probably quite a bit of value creation over the next 5 to 10 years.
Great, thank you, John. Let's talk about risks. I think as Jewish investors, we're probably very focused on the risk element. I think probably a conservative group of investors. And as I mentioned, the ORAH Fund in general, we're very conscious of protecting the capital of our investors. So let's get our panelists' views on some of the risks over the coming years. Mark, let's start with you. There's a lot of talk in the world that the world is going through a period of economic progress, if you like, or lack of progress, similar to what Japan has experienced over the last 20 plus years. What is this and why is this?
Well, we think that it's really aging population, so it's a big impediment to economic growth. So Japan's been experiencing aging population and in fact negative population growth for an extended period of time now. Another thing is that government debt levels in Japan are very high, and we think that the world has effectively been turning Japanese over the last 13 years since the GFC, because you've had that an accumulation of debt over the last 50 or 60 years in society generally. You've had rising wealth inequality, and there's been a gradual hollowing out of the middle class, particularly in developed markets. And I think the world is starting to bang up against natural resource constraints as well, and disruptions, including climate change. Tech is great in terms of making better products that are cheaper, but tech is also going to disrupt human capital markets more and more going forward. And there's going to be a lot of disruption, as I mentioned before, in energy markets. So that's going to be deflationary. So we think governments around the world have been adopting key elements of what the Japanese government's been doing for over 20 years now, and also the Japanese central bank. So really low interest rates, a lot of money printing. And then COVID-19's really just, we've seen another boost in government debt levels in response to that crisis. So we think that that's, high debt levels and all of these sorts of structural impediments are going to mean that we're facing a low growth world. And that really brings me back to the point I made previously. You really need to invest in businesses that can take market share, because if the economic pie is not growing, taking market share is really the only way for a business to grow its revenues and profits. So when you're thinking about investing, you should really think of that sort of framework and focus your capital on businesses that can grow in a low growth or no growth environment. And also innovation is really the key driver of organic growth over long periods of time. So you really need to look at investing in innovative businesses.
Thanks, Mark. Damien, so we live in times of great uncertainty, which we all probably guess that are likely to be with us for many years to come. As investors, how do you deal with uncertainty?
Well, look, I think uncertainty is always with us. I don't think anybody knows what the future holds. We've just had a strange outcome to a US election. We've got China-US tensions. We've got tensions in Europe. We've forever got tensions in the Middle East. And we've got low interest rates, lots of leverage, and all the other things. So uncertainty always persists. But we think there is a way to approach it, and that's to find certainty. So if you approach your portfolio construction and you look for the companies that are certain, or as certain as you can possibly get, regardless of what the environment is around them, then you build a portfolio of those at attractive valuations, then you're going to have a portfolio that's going to deal with uncertainty a lot better. So I've spoken about dominant intangible assets and these more sort of bulletproof investment models, and a way of characterizing how we deal with certainty is the things that we don't invest in. So, we won't invest in a bank or an insurance company or an investment bank, because they're highly leveraged and they're exposed to the interest rate cycle, and we don't know where the interest rate cycle is going. Therefore, we don't know where their margins are going, and we don't know the quality of their credit, etc. We won't invest in companies or industries or sectors that have no pricing power. If you're an energy company or a mining company or even a utility company, then the price of the thing that you sell is not determined by you and you can't control it. So you can commit to a mine and you can dig a big hole, and by the time you've finished digging that big hole, the commodity price that you're selling can collapse, and then that hole is worth nothing. And that also speaks to capital intensive industry as well, things that cost a lot just to get into business. So down here in Melbourne, we've got the Chadstone Shopping Centre, which has the biggest catchment of any shopping centre in the Southern Hemisphere. And that's a great business because it attracts a lot of high-end shops and their flagship stores. But the problem is you can't expand beyond that catchment without spending another few $1 billion. And if somebody else comes in with a few $1 billion and can actually sit in your catchment, then suddenly you've got two players competing for the same set of clientele and your pricing power diminishes. So there's all of these business models that we won't invest in because they mean that your clients' capital can be sideswiped by uncertainty. So the best solution to uncertainty is certainty in our minds.
Thanks, Damien. John, can you give us your thoughts on a trend that we're seeing that appears to be dominating markets at the moment, and that's a lot of funds have been flowing into passive vehicles. ETFs specifically. Does that concern you as an active investor in the global small cap space?
You know, I think it's something that, you know, all of us have probably dealt with and thought about up here on the panel. And, you know, it's kind of one of the, you know, you've heard from all the panelists that we all think a lot about business models and a lot about how to invest in businesses. However, there's this kind of other elephant in the room, which is passive money that has really, these fund flows have at times played havoc with equity prices. And, you know, you've seen a bit that happen a bit in the FANG space as capital flowed in and really drove up prices. And so for us, you know, I think, you know, passive has been this interesting deluge that's kind of impacted the market, but ultimately we're now, I think, getting to an interesting tipping point where it's actually starting to create significant equity price movements at times, especially as you see volatility in periods tick up, you know, whether obviously COVID was a unique period, but even before that, I think you start to see signs of volatility picking up. And I think that's really ultimately very good for all active managers, especially long-term oriented active managers who have an opportunity finally to start buying some equities at discounted prices. And what we love about the small cap space specifically is we're really kind of operating under that passive, you know, underneath where a lot of the passive money is flowing. And so what we love about our universe is, you know, we have the opportunity to buy these kind of franchise, high quality businesses, but really in a space where a lot of other investors aren't looking or spending time looking. And for us, that generally is something we really like, because ultimately it means there's less capital chasing these ideas, and we're buying them at slightly cheaper prices in our view. And so for us, we think, you know, passive actually has created a good, it now is enough of the market to create a pretty good environment for active managers, and active managers are really poised well to outperform over the coming, you know, 5-10 years, whatever it might be. So I think for us, I think we think we've hit a critical tipping point in passive, and active managers are pretty well poised. And I think you've seen that in the data in terms of active management really outperforming passive over the last 6-9 months since the COVID bubble, or since the COVID turmoil started.
Thanks, John. That's really good food for thought. A bit of a contrarian view, I guess. Steve, the world today, and indeed into the future, seems to be subject to extremely heightened risks, whether they are geopolitical, medical, economic, etc., etc. How do you manage these risks while continuing to be invested into the market?
Yeah, look, our approach is actually to try and make money from the risks that we can see. So an example is when volatility is very low, so that means when markets are very stable, there's a risk that something's going to jolt the markets, and we're going to see an increase in volatility, and that normally results in share prices declining. So we invest in businesses that actually benefit from the volatility. An example are market makers. So market makers are people that stand between buyers and sellers in stock markets. And they make more money the more volatile markets are. So we have an investment in a Dutch one called Flow Traders. And every time there's a market sell-off, that company does very well, and we make money from it. You have to position the size correctly, but that is an example. Another example is a company we own called Billy & Loki, which is the world's biggest debt restructuring advisory firm. And so if there's an increase in bankruptcies, that company will make more money. We do own some tech businesses which benefit from a slow growth world, but we also invest in companies like derivative exchanges, which actually will benefit if there's a spike in inflation. Derivative exchanges do very, very well, because that means all financial institutions have to buy derivatives, which are insurance products, to protect themselves. So I think the key message we make there is we try to identify the big risks, and then we actually try to make money off it. Outside of that, we ensure that our portfolio, the companies we invest in, have little to no debt, so they can't go out of business, are highly cash flow generative, have some competitive advantages so they can continue growing, have good management teams, and our portfolio is nicely diversified. And when you bring that all together, you do land up with a portfolio that generally has historically withstood market downturns, and we anticipate it should going forward.
Thanks, Steve. I think we're all on the lookout for those types of stocks that can make money when the markets hit a wobble. So that's great insight. Unfortunately, ladies and gentlemen, we have run out of time. So we will be stopping there. Thank you to our panelists and indeed all the ORAH managers. Our panelists today, your presentations clearly illustrate why we are so blessed to have you as our partners in the ORAH Fund. Thank you everyone for attending today. To those of you who are already ORAH investors, we thank you for the great impact you enable the ORAH Fund to make on to so many causes. And to those of you who are not yet ORAH investors, we hope to be able to welcome you as investors in the near future. Please remember that next week we will be running our Australian manager webinar. Hope to see you there. Thank you.